Welcome back to the channel. Please, if you are new to this channel, please subscribe. Let us reach 1K subscribers by the end of 2026. Please leave your comments and your questions in the comment section, and I'll answer them one after the other, either in the video or directly. Please, we are on the journey of our SMC mastery course, and today we are looking at fair value gaps. In the previous video, we looked at demand and supply, and we are looking at fair value gaps and how you can treat them profitably. Fair value gap, also known as imbalance. They are open prices, okay? Their open price ranges from large candles which leave wicks untested. They are open prices from large candles which leaves wicks untested. You can see that fair value gaps are always in the candle of 3. So let's take a bullish scenario. We have 3 candles, 1, 2, 3, and you can see that the upper wick of the first candle and the lower wick of the last candle, they are not touching. So you can see that there's a gap in between this to this, okay? And in real sense, market is supposed to fill all the others from this last price to this price. But if market fails to fill these gaps and immediately closes like this, and this one fails to come back to take the price where it stopped and close above, and it decides to leave a gap, this gap needs to be filled. We call it fair value gap. It needs to be filled. Some also call it as what? Imbalances. It needs to be filled. Look at a bearish scenario. It is always in a scenario of 3 candles, and as you can see, and you can see that from the first bearish candle to the last candle, you can see that these wicks are untested, and it has left an open price range that is unmitigated or untested, and these prices needs to be filled. Others needs to fill these prices. Sellers needs to sell from all these prices, okay? They cannot sell here then jump all the way to this price and start selling. They need to sell all these prices up, so the market will come up to fill these gaps before it can what? It can continue. Let's look at this scenario. You can see that from here, after the first and the last red candles, you can see that it created a gap in the middle. You see that this week and this week, they did not touch each other. So it means there are orders that are unfilled here, or there are prices that have not been entered yet. So we expect the market to come up and fill those prices before it will continue down. Look at this place. From the first green candle to the third one, you can see that we have a gap in between them. You see that the wick of the first one and the wick of the last one, the lower wick of the last one, have not touched each other, which means there are orders that needs to be filled. It is a gap. So we expect market to come into their unfilled gap and fill them. We call it mitigation in SMC or ICT. Look at the real chart example here. From this candle to this candle, it created a gap. Okay, this gap needs to be filled. So you see the market had to come back and fill the gap before it can continue. From here, you can see that anytime market gives a large bullish or bearish candle and leave gaps, the market will always come up to fill them. Look at this scenario here. You see this scenario. You see this scenario. Anytime you see gaps, the market will always try to fill. In fact, any gap that's created like this needs to be filled 90 to 95% of the time before the market will continue moving in the direction it wants to move in. Okay, let me show you real chart examples, and then you understand how they are being traded. Now look at this place. Now look at this chart. Look at this chart. From this candle, okay, from this candle, from this green candle and this candle, this red candle, you can see that there's a range or there's a gap. From here to here, market did not fill in those orders. All these prices have not been filled yet. So what do? We mark it out, and we expect price to come to that zone, and we either take an entry or we expect a reaction from that zone. And as you can see, price did exactly that. Price has to come into that zone and filled the unfilled orders before it will continue. Look at another one here. You can see, look at another one here. You can see that from this point, from the last week here, okay, and this candle, and this candle, and this candle, market did not mitigate it, or market did not fill those orders. So what do? We mark it out, and we expect the market to come inside it to fill those orders before we can what? Continue. So when you look at the charts, you see that most of the time, anytime market leaves an open gap, it will always try what? To come and then what? Close it. And look at another one here. You can see from here, from this candle and this candle, that's two open ranges, okay? And the gap, you can see from here to this point, market needs to come in what? To fill those orders. And as you can see, market did exactly that. Before what? It continued moving up, okay? And it continued like that. As you can also see from here, look at it from here. This is the last. Look at the upper wick of this first candle and the lower wick of the third candle. What happened? You can see the price left a gap that needs to be filled, and market did exactly what we expected. The market needs to come into the zone and then fill the unfilled orders and continued. Look at some here. Look at another one here. From this upper wick, okay, and this lower wick, you can see that there's a gap. And what did market do? Market came in, filled the gap, and then it continued. And it's like that. In fact, fair value gaps forms on every time frame and on every day, every time, because anytime there's a massive buy or sell order, it will create a gap, and that gap needs to fill before the market will continue. So market will always come up to fill the orders before it will continue. So as you can see, so you see from this gap, market came in and filled the orders before it continued. It created another gap here, okay? Let me zoom in so that you see. Okay, you can see from here it also created another gap. And what did it do? From the last candle, okay, what did it do? It needs to come up to fill it. And as you can see, look at this week. This week actually came into the gap and went out, and the market continued like that, okay? So this is how fair value gaps are. And if you want to trade them, it's just simple. Once the gap is created, you just, let's say the gap is created this way, it means that the market is going up because the gap is created in an uptrend market. So you just put your buy limit here and your stop loss below the gap, so that market coming in won't kick you out, okay? In this case, you place your buy here immediately and your stop loss immediately below the gap. And what did you do? The market will come in and mitigate you, and it continued, okay? As easy as that. And that's how you trade gaps. That's how you trade gaps. And in fact, gaps alone is a strategy on its own. There are people who trade only gaps and they are making huge sums of money. You can see only gaps and you'll be making money. You can see only gaps and you are good to go. Just gaps, okay? So that's how these fair value gaps are created and how you can trade them. And you can even see today from here, the market is reacting from this gap. You see the market is inside the gap. It is filling the gap orders, okay? So that's how fair value gaps are. And if you don't understand anything in my explanation, please don't hesitate. Put it in the comment section and I will make another video to explain the concepts much better for you to understand. Please subscribe to the channel and I will see you in the next video.